the smart guys in the room, the guys that have been there a long time, they don't talk about the upside. They talk about the downside and how do you protect the downside. And I think that's where, again, the size of asset becomes exciting because it really is about risk adjusted return, right? So you're trying to get as much return you can for giving as little risk as possible. It's like Warren Buffett's quote, first rule, don't lose money, right? And then from there, you can think about, what the potential upsides could be. And one thing that real estate's always proven is like over time, it will provide a good return. And so, but anyway, I just think it's a great mindset shift for folks.
Welcome to the Doctors Investor Club podcast, where physicians and dentists come together to elevate their mindset, build their assets, and create a lasting legacy. I'm your host, Dr. Kyle Stevenson. After years in the OR, I've realized wealth is not just about high income. It's about ownership, freedom, and using your money with purpose. Here at the Doctors Investor Club, we share the strategies the wealthy already know: owning a business, real estate investing, becoming your own banker, and intentional investing. Each week, we sit down with entrepreneurs, investors, and physicians who've stepped off the hamster wheel and are building wealth that outlives them. Because at the end of the day, it's not about how much you make, it's about how much you keep and the impact you leave behind. Let's get into today's episode. All right, welcome back to another episode of the Doctors Investor Club podcast. I'm your host, Dr. Kyle Stevenson. In today's episode, we're going to talk about real estate investing, in particular, institutional investing that can be available to most of you listening, which is awesome. Our guest is Kent Ritter, founder and CEO of Hudson Investing. After selling his medical consulting business in 2015, Kent began diversifying into multifamily real estate, first as a passive investor in multiple syndications. Then in 2019, he acquired and GP'd a 250-unit Class B property in Atlanta, which led to the launch of Hudson Investing. Since then, Hudson has grown intentionally, building out acquisitions and asset management teams and vertically integrating operations. Today is about understanding how operators think and what physicians can learn from that mindset. So welcome to the podcast, Kent.
Kyle, man, thanks for having me on. I'm really excited to be here today.
This is awesome, man. It's a long time coming.
That's right.
We've had you speak at meetups and at the Legacy RX conference. And so, I think people are in our community are getting to know you for sure, seeing some of your deals. And so we're excited to finally have you on the podcast.
Yeah, that event you put on was really special, that Legacy RX conference, and getting to meet a ton of your peers, a ton of your friends, a ton of doctors that are trying to, they just understand that they can't just be passive in their finances, right? Which is like just one of my major mission is just teaching people that you got to be active. You got to be an active participant. You got to understand investments. You have to understand there's just more than stocks and bonds, which is like all they really sell to you, and your 401ks, and you gotta understand alternatives. And so just loved meeting an entire just community of people that were all about that. That was super cool. That's out of my core space, which is all real estate folks, right? So it's cool to meet this whole other industry and group of people that just get that. So I loved it. It was really, really fun to be involved.
Good point. And really, that's what we're going to get into today. A lot of docs do hand the money to financial advisors and have them invest in stocks and bonds, and that's really all they do. Yeah. And so it's good to enlighten them with real estate investing. But real quick on that note, we had 8 speakers for the conference, and I want to say all the speakers did a good job, but you're the only one that got Q&A, which is pretty cool. So you offered up, any questions, and people were very glad. Like everybody was raising their hand. It was awesome. Yeah. It was like the best back and forth between speaker and audience.
Well, so. It was a smart group of people, right? Which you expect doctors to be smart folks and obviously are. And they asked some just amazingly educated questions, which I think probably just goes back to the community as well, right? Like you're educating people, they're educating themselves. So it's fun. It's always fun when you have people that ask smart questions. So yeah, it was cool. It was really fun.
No, we appreciate you. And I actually had a buddy at the end. He's a physician down in Georgia. He's been investing in real estate for a long time. He's like, dude, I knew most of these speakers. The one I didn't know was Kent Ritter. And he's like, I just thought it was like one of your buddies, and like, okay, this would be cool. He's like, I was impressed with him. Like I loved what he had to say. So it was really neat. I was like,
Love
he
that.
actually is a buddy too. So
Yeah. Yeah. You could be both.
that's right. Yep. All right. So
Awesome.
real quick, let's get into your background a little bit, how you started Hudson. First,
Yeah.
I know that you're an Indiana Hoosier. You went to IU, correct?
Go Hoosiers, baby. Natty champs. Can't even
Dude,
believe it. I'm still just living that high.
it's wild. Greatest story in sports,
I
I think,
know.
is that. And the fact that they did an undefeated season coming off the losingest, program in history.
I know.
Undefeated season, 50 years to the year that Bobby Knight and the basketball team went undefeated. So
Cool. It was
insane.
so cool. And yeah, man, we need that as Hoosiers. We don't get, we haven't had a lot of wins lately. So the community needed it. And what was cool was, everybody came out. There was like 50,000 Hoosiers at the national championship. So
yeah, it's amazing that every playoff game they had was basically a home game with a crowd that came out.
That's right. I think everybody understood that it was a special moment that might not happen again, and we wanted to capture it. So yeah, dude, that was cool. But yeah, so I'm a Hoosier, born and raised in Indianapolis, and lived here my whole life outside of spending about 10 years in Chicago after graduating from college. And that was where I had that other business you mentioned. And so, that's really, it was really, I went to school. So, I went to school for finance. And so one thing I said, I remember in my speech to your crew was like, you guys go to medical school and you are learning amazing things, but you guys are not learning really about finance and how to invest, right? Like that's not really on the curriculum. I literally went to school for that. So like I went to IU, I went to the Kelley School of Business, went finance, and then just niched down even more into investing. And really was focused on investing and what they focused on really was stocks and bonds, even at that time, And so I had one real estate finance class, and they taught us to go buy 10 single family homes. So there was nothing that was even remotely close to really institutional real estate, buying real estate at scale, which is what we do now, which is really the right way to do it. The best risk adjusted return. And it just wasn't even part of the curriculum. So it's like, when you think about that education gap, and then again, it just goes back to like, how can you be expected to know these things? It's things that I picked up just along the way. But what got me interested was really understanding I needed to diversify. When I started to think about selling that business that I had, which you're right, was in kind of the medical IT space, working with companies like Epic and a lot of health systems. When we started thinking about exiting that business, it was like, okay, well, what are we going to do with the capital, right, from that exit? And how do you plan for an exit like that? Because, there's tax consequences, right? I mean, there's a lot of things that come with it. And so that was really what got me interested in not at first real estate, but I need to diversify because I don't want all my eggs in one basket. I don't want all my money in stocks because I've been investing in stocks for a long time. And so how do you diversify? Well, you start talking to a lot of people, start talking with people, older and wiser than me. And it came back to real estate. I kept getting that advice, invest in real estate. It's tax, for all the reasons, tax advantaged, right? Great cash flow, appreciation, all these things, which are the reasons that we all want to invest in it now, were things I was learning. And so I started investing in real estate as a passive investor, even before I left that company, as you said. And really that was about learning how this all works, right? Investing with sponsors. What does that mean? What can I get in return? How does communication work? And then as I exited that business, my interest in real estate had grown and just grown and grown. And I really fell in love with it. And I saw, I was starting to experience all those good things about it. And I wanted to just grow and scale. And so that's really what led me to, for a long time, I was investing with my own capital. And then what I learned through some great mentors is really, again, how do you build scale in real estate? Well, it's like, let's pool our money together so we can all go invest in something bigger and better than any of us could individually. Right. And that's what we do now. Very simply said, is I'm pooling our investor money, our friends and family money together so we can go buy something bigger and better than any of us could. And then I've built a system, like an operational system, a company to go and run those properties in the best way, better than any of us could on our own, by hiring industry experts to go do this for us, right? And so I think that's what's so important about kind of building the mechanism I have, is to really create great returns for investors, myself included. I'm investing alongside every deal, and be able to do it in a very operationally sound way, not thinking that any of us, I think one of the fallacies people make when they start investing, and I did too, it's kind of like ignorance is bliss, right? It's like, oh, I'll just go buy a single family home and I can be a landlord. Like, why would that be hard? Right. And it's like, there are people that literally go to school to learn how to be a landlord, and they do it for 20 or 30 years in their career, and they're experts. It's like, why do we think that we can just pick up and do that? Right. And so it's really what I've built now is and what's become just this amazing growth story is this company. We have industry experts who've been doing this for 20 and 30 years now, running these properties for us. So I know it's a long-winded answer to your question, but it was, that's what got me into real estate and got me interested in kind of my background and story that led me to real estate, is all about how do I diversify, because that's how you get safety, right, with your capital, and how do I invest in a very smart way so that I have diversification, but just a great risk-adjusted return, which is what we're all looking for, right? Like you're trying to have as little risk as possible with a greater return as possible, right? And I think that's part of real estate.
Yep. No, I love that. And a couple of points I want to touch on real quick, and we don't want to, belabor all this, but I think it's important. A lot of doctors, like, we hear, okay, invest in real estate, sounds good, right? Leverage and, all the things you just talked about, tax benefits, this, that, and the other, which there are, and that's all true. But the hardest part is, how do I get started in real estate? So for me personally, 5-6 years ago, we started being a limited partner, similar to what you did in syndications, right? And that sounds good. And then I was like, well, I got a tax problem. I need to do more. So I started buying my own properties. And then now I'm like coming back full circle, because I've seen how tough it is to be a landlord. I mean, it truly is a business. Like, if you want to start a business, being a landlord and doing short-term rentals and doing your own active real estate is fine if that's all you want to do. But if you're a busy physician, it's hard. It's a lot of hard work. And so now for me, going full circle, I'm going back to the limited partner, and I'm investing with guys like you and smart operators who I can be hands off completely and focus on my job, making an income. And so I think a lot of docs need to hear that. Like, it is tough to invest in real estate, and it's not as sexy and easy as some of these gurus, quote unquote, make it sound.
That's right. They call it like tenants, termites, toilets, all those things. Right.
Yep.
I think there's two ways to think about this, right? As an individual, if you're going to go and you're going to invest, right? There's two ways to think about it. One is, man, I'm really, and I'll just put myself in a doctor's shoe. You could say any profession, but let's just say you're a doctor, right? And you're like, man, I am a kick-ass doctor. Like, I'm the best doctor, and I'm killing it, right? So because of that, I can go buy a property, and I can also be a really kick-ass landlord, right? And I can be an immediate expert in real estate and owning a property and everything that comes to it, from like mechanical, like maintenance, right, to how do you write leases, to the contract law, to all the stipulations and things that you have to understand. And you can think, okay, because I'm good at one thing, I can be good at anything. But what happens is, you can you can move an inch in 1,000 different directions, or you can move a mile in one direction, right? And so if you spread yourself out too thin, I think it dilutes everything that you're trying to do, right? And what you said is absolutely right. Owning a single family or 12 single families like I had at one time is an absolute full-time job. Then there's another way to think about it, right? It's okay, as a physician, especially because it's even more cost and time going into it, where you guys go to school for a long time and you become highly specialized experts. And because of that, you're paid really well because you're providing a ton of value. The other way to think about it is, wow, I spent all this school and time on this. I'm an expert in this field. Let me absolutely maximize that. Let me make as much money as possible being a physician and be the best physician possible. And then let me find other experts in other areas that love, let's say, real estate as much as I love being a physician, and have the expertise just like I do as a physician in real estate. And let's rely on them. right? And then that's how you build leverage, right? So you can go a mile in your direction and then go a mile in their direction. And I think that's the other way to think about it is it's the who, not how problem,
Yep.
right?
100%.
It's how do you find the right people in any point in your life to do it for you, to give you leverage versus you trying to do everything yourself and getting nothing done.
Mm-hmm.
Right. And so I think that's the right way to think about it, especially as a physician who is so highly specialized and valued. How do you maximize that? And then how do you diversify by putting your money, not just real estate, but maybe other places with experts in that
Yep.
field that can go and double, triple your money so that your money is now working for you. You're not working for your money is the whole point.
Yeah. Nope. That's great. The Dan Sullivan, Who Not How. Fantastic book.
Yeah.
Fantastic.
Yeah. Great book.
Mindset. So, with that being said, let's talk about Hudson, what you built, how you've, gone through, really pushed through these last 4 or 5 years where a lot of people are having a hard time. What sets you guys apart as multifamily investors? And I'll just maybe even start by saying a lot of doctors out there are getting emails left and right from, multifamily syndicators, or, self-storage or whatever. And there's like 1,000 different ways they can go. Why would somebody, choose Hudson and go with you guys?
It's a really good question. I mean, I think what sets us apart are a couple things. One is that myself and then my business partner, Curtis, and really everybody at the leadership team level, we all come from a really good background of whether it's selling, whether it's being an entrepreneur, understanding businesses, selling businesses, or whether it's being an industry expert and being in the real estate industry now for 20, 30 years. And that's just the level of quality at the leadership team that you're getting. So I think one, it's just, we're not guys that just started it last year and are trying to figure it out, right? I mean, Hudson's 7 years old now. I've been investing in real estate since about 2012, 2013.
Awesome.
And so there's the pedigree there. Something I didn't talk about in my background was, I call it my real estate MBA. I actually went to work for one of my mentors for 2 years who owns a large institution, about 25,000 units, to really understand how it works, at a large institutional level before going out on my own. And that was a huge value for me. Curtis also came from a large shop. So he understands. So it's just this institutional kind of pedigree, but this entrepreneurial attitude and mindset, right? Of really running the business and having the, just that ownership level. And part of it is like bringing our own management in-house, right?
Mm-hmm.
Right. I think that has given us an incredible amount of control. It's given us an incredible amount of insight into our properties. And that's something that I would really look for with someone I'm investing with is, do they have management in-house? Are they vertically integrated? Because what it's just enlightened for me is how really in the dark we were before we brought our management in-house on, the access to information, the ability to make direct impact to the properties, right? And the ability to not just manage off the financials, which are largely behind you, but manage what's coming, right? And manage on the daily and weekly level and just be able to make an impact before things become big problems. So I think having management in-house, and we've also just grown very responsibly. I mean, we haven't been out to grow to the moon. We've been out to acquire one property at a time, do it in a very thoughtful way, and make sure that each property can be successful. And so, it's really about this long-term vision of growth where I'm just, as now really my second business, taking the lessons learned from growing my first, but applying a much longer term strategy, because my goal is not to build this thing and sell it in 5 years. My goal is to do this for the next 20 or 30 years because I love what we're doing. I love that we're providing this value for folks, and I just really enjoy the real estate process. And so, I mean, those are a few things. I think also at the end of the day, we got to provide great returns to our investors, right? I mean, that's why people are investing with us, and the care that we put into it, the ownership we have, and the ability to provide, I think, some great returns are all reasons why people would look to invest with us.
I love it. Yeah, a couple of things you brought up that I just want to highlight. I mean, last year you guys vertically integrated with property management. That's huge. And anybody listening needs to understand that how important that is. And I can just tell you anecdotally from, I've been in this space now for, 4 or 5 years, and I've seen really good operators that still have third-party property management groups, and they just keep churning, they in and out every 6 months. They're getting a new property management. And finally, like with this one guy I know last year, he actually went from New York, where he runs his operations, down to Atlanta, Georgia, to live in the property and manage it himself because he just could not find a good property management group. Right. So, and those stories are going on all over the place. And so by you guys bringing that in, that's such a huge asset for you guys.
Yeah. And that was the same roller coaster ride we were on, unfortunately. And, and the analogy I use is like, nobody's going to love your baby like you love your baby.
Yeah.
Right. And it's like, nobody's going to care for the properties like we will care for the properties. Nobody's going to work harder to get returns for our investors than we are. And I'm extremely proud at the culture we've built at our company, our core values. We live, breathe by these core values. And unfortunately, when we got to our client, right, the residents on site, we had a third party in the way from delivering our culture down to the bottom level, down to the property, right? And giving those residents a fantastic experience. So they want to stay. And I just always felt a gap there. And so that's why, and I think that's part of the entrepreneurial attitude we have. It's like, well, don't just continue to be frustrated with the status quo. How can we fix it? Right. And so that's where we decided that, we're going to just break it to make it better. And we're going to bring it in house and we're going to build it from the ground up. And it has been better. It has been. And so, and it makes us a better, safer, more reliable operator with more control of our destiny and where the properties go.
Yep. I love that. Yeah. To your point, like you guys are really good about having systems in place, which I love. Any good business should have that, but most businesses don't. And so you guys do a good job with your systems, your culture. And to your point, now that you have property management in house, that culture and systems, that all permeates down into the tenants, to the property itself. Whereas before, it sounds like, there's a little bit of a break in action because it's a third party with their own, culture.
Their own agenda. Yeah. Their own culture, their own profit motive to make a profit for their company. Right.
Yep.
And so we've seen a major impact. I mean, we've seen expenses come down dramatically. I mean, because again, it's not their money, right? So they're spending like a teenager with their dad's credit card, And so we've seen expenses management really come in and performance improve. So it's been an absolute game changer for us, and we're very happy that we did it. And I agree, systems are so important. I mean, that's the consultant in me, right? Of building systems and process and repeatable things. I mean, it's really variability that will kill your business, right? It's like you find the best way to do it and you just do it that way over and over again is what's so important. And that's what we've been able to instill in our operations.
Yep. That's amazing. So, when I talk to physicians or anybody that calls me and asks, who should I invest in? It's always look at the track record, see what they've done in the past. Have they gone through this before? Have they exited anything? So let's talk about Hudson's track record. You guys been in existence now 7 years.
Yeah.
But it's been a long time coming before that. But let's talk about your track record, exits, things like that, things you've learned over these last few years. And then I want to get into institutional investing.
For sure. So track record wise, we've successfully exited 4 properties. We've honestly, just with the market timing of the past couple of years, with interest rates so high, we've been waiting on several more exits, but our properties are doing very well. Our portfolio occupancy is above 90% across the portfolio. That includes, a couple properties that are in lease up that we've built. So everything is going well. I mean, really across the portfolio. A lot of that is market selection. I can say we're fantastic operators, but you can be an amazing operator if you're in a terrible market. Right. It's tough to change the neighborhood around you. And so I think one thing we've done extremely well is selecting the right markets. We've even niched down more specifically in the past couple of years. Really, Indiana has so many good things going on. And it's here where I live in Westfield. It's really hard to look outside of Indiana right now because we don't need to find great places to invest. I mean, if you look at whether you're on the South side, and there's just an amazing growth story there and kind of, growth, whether you're, kind of Franklin, whether you're down on the South side of Indy or you're on the North side, like in Hamilton County, just a tremendous, amazing story of growth where Westfield has grown like 34% in the past 5 years. Or I think that's the stat. It's incredible. And they're expected to grow kind of another 10% in the next 5 years. And so, part of it's market selection, right? It's great to have a great growth story. It's great to have job creation. That's really what makes, a great place to invest, and in good schools. And so we have that. And because of that, I think our Indiana properties have done fantastically well. Our Ohio properties are doing well. And just the Midwest as a whole is kind of having a heyday right now, with rent growth and good occupancies. Versus some other markets you hear, if you look at the headlines, you hear a lot of headline news of like, oh, rents are down not where we are, not in Indiana and Ohio. You go to Austin, you go to Phoenix, you go to Atlanta, then absolutely, because those are all overbuilt, but we're not seeing that in our market. So it starts with the markets, that helps us produce a good track record. But yeah, I mean, we expect to exit a couple deals this year where, the IRRs to our investors that we're returning, should be in the 40s. Some of the deals that we bought, now 5 years ago that are at the end of their cycle, and we're excited to be able to, get those returns to our investors and kind of hopefully redeploy that capital and help them, double down and continue to build that snowball.
Love that. And we talked about this before we got started. I mean, you guys have really just continued to grow. Even these last few years have been tumultuous for, just the market in general, or, a lot of groups, real estate, specifically. But you guys have seemed to power through and continue to do well and continue to grow even with those headwinds, right? So, yeah, go ahead and talk about that.
Well, like I said, we've always set out to grow responsibly. And so I think, thinking that we don't have to grow a tremendous amount, being very selective about the deals that we choose, getting creative at times. We did a deal in South Carolina that was a student conversion, which is just, it could be a difficult process of switching out from renting to students to renting to conventional renters. It was a heavy rehab project. We did that. We bought that in 23 because we got it at a fantastic price, on it with a fantastic interest rate. And, but we were willing to kind of roll our sleeves up and get creative, to continue to find some deals that weren't kind of right down the fairway. Right. But just being selective, just doing, a couple deals a year, not overextending ourselves and not ever compromising to just get a deal done. I think that's so important. I think, it would be really easy to go into a deal just to bring in fees, that maybe wasn't a great deal, on the surface for our investors and for us long-term. And that was something as we set out, like we just said, we never want to be about that. I think thankfully enough, we've been well capitalized enough. We don't need to, and we've just been really smart about it. And I think that's what's allowed us to continue to grow. Well, we kind of grow like the Midwest, like I said, just slow and steady, moderate, not these big up and down swings where we're hiring a ton of people. I look at my team like the Navy SEALs. I want a small group of highly talented people, not the infantry, not 100 people out there. And so we've just slowly built, but we've got about 40 people on the team now, which is exciting.
That's huge.
But yeah, I think that's why we've been able to grow, while others have contracted, just because we never had these massive swings up and down. We just kind of steady and grow and grow responsibly, like we said.
I love it. The more I learn about investing, the more I love that, like more certainty, more steady growth, kind of, boring investments, if you will, like not the home run or VC, venture capital type thing. And it's funny. I went to an investor summit in Beverly Hills in September. Ron Artest, Meta World Peace is his name. Formerly known as Ron Artest, but he was talking about his investments, and he's like, man, the things I've learned over the years, slow and boring and steady are the investments that do the best.
That's right.
And so that's what he's, relied on. And that's what I like in the Midwest investing too. It's like there are jobs here. It's consistent growth. It's not going to be a home run necessarily, but you're also not going to get the negative swings like you would in those, more coastal markets.
That's right. I mean, I tell people like, look, we're the vanilla ice cream of investing. We're not a hot fudge sundae. We want to be that boring kind of foundation, that just kicks off cash, and just does really well. Right. And if off that foundation, somebody wants to go put, 5% or so into, some flyer with VC or something, it's just, you just have to have all different risk profiles. Sure. Right. So we try to manage
gamble.
To be on the lower end.
You could also just go put $1,000 or $100,000 on red too if you want to, right?
You could, yeah. You could try like betting on the Bears or something, which is never going to go well. But I mean that's the thing. I always tell people as well, like because a lot of people resonate with sports, and like we're trying to hit singles and doubles. We're not Barry Bonds or Babe Ruth back in the day, right? Where you'd strike out more than you'd hit, but you just nail home runs. Like that's not what we're going for. We're just looking to go around the bases, right? We're looking for base hit. We're playing that money ball game, right? Mm-hmm. Just base hits, get around the bases, and score runs, but stay active, And that's really what we're looking for in our deals. We're looking like when we underwrite deals, we will put that baseball analogy out for people saying like, hey, we think most likely we're going to hit this double. There's a chance we only hit a single here, right? But there's also could be a chance we hit a triple or a home run, mm-hmm. and this is what that could look like. But we're really trying to get you to focus here, right, on that double, and be happy with doubling your money in 5 years, which is always the goal that we set out to do. The easiest way to say what we're trying to do is double your money in 5 years, which beats the stock market, but also provide a tax advantage solution to do that. Right. And be able to give a lot of that depreciation back that helps people cover other gains. And, you won't have to, you shouldn't owe taxes on your gains while you're invested in the deal, because the coverage on depreciation, that's something that's unique to really only real estate.
Mm-hmm. Yep. Absolutely. Love that. And docs need to think about taxes more than, not just docs, but everybody needs to think about taxes.
Yeah.
Well, let's get into your growth and where you guys are going this year. There's something big coming up. We want to talk about the term institutional investing and what that means. So, you're talking to doctors now. You're not talking to real estate professionals or real estate people. You're talking to us. So if you can just dumb it down into like fourth grade level, we would appreciate that. But what is institutional investing, and how does it relate to what you guys are investing in here now?
Yeah, good question. So I think when you refer to institutional investing, you're talking about a couple things. You're talking about the type of asset, and a lot of times it has to do with scale of asset. So for example, we would call like an institutional quality product, something like the product that we're acquiring in Westfield right now, a property called Maple Knoll. And the reason we say that is because one of the size, it's 300 units. And one of the major lessons I've learned in real estate is that really safety comes in scale and economies of scale. So the bigger, the better, because you're just spreading risk, across more units. You can have more, like our break even occupancy on that property is about 75% occupied. Like think about if you have a single family at the other end of the spectrum, right? Like if you lose one person, you're paying the mortgage, mm-hmm. right? The current occupancy is 96%. We could go all the way down to 75%. So that's, 20% on 300 units. We could lose 60 units, right? And still pay all the bills. Mm-hmm. And still pay the mortgage, still pay all the expenses, right? So there's just this safety. So part of it is the scale, the quality of the asset. It was built in 2008, so it's not very old. So a very high quality asset is what we're talking about when we say an institutional style asset. And we say institutional style because we talk about these big institutions like these life insurance companies, these REITs, these major private equity groups, these billion-dollar firms. These are the type of assets they buy. Mm-hmm. So with all their knowledge, all their resources, these are the things that they go and buy. So we say, okay, institutional, these big groups go and buy these assets that are 300 units, these class used to be A, now it's probably a B plus just because it's 17 years old, and that's why we're going to bring it back up. But these large, high quality assets, essentially. So you're talking about the groups that are buying them, the type of asset. And the reason that we're so excited about buying this quote unquote institutional quality asset, right, is because there's also something we know about a lot of these large institutions and how they run properties, right? They're experts, right? They have these smartest people, from the best schools running these properties, right? With the best data. They take care of the properties. They spend a lot of money making sure the properties, stay high quality. And so they're always well run. And so we know we're going to buy something that's well run. We know we're going to buy something that's been well maintained, because in the life of this property, Maple Knoll, for example, it really, you look at the ownership pedigree, it was like GE Capital to Blackstone to right now it's owned by a large insurance company. We're going to be the next owners of this property. And so we're just super fortunate to be in that tier. And then you think about these groups they've got, like we talk about, process, repeatable process, right? Great systems. So you just know it's going to be good operations, but we also know that typically where I think there is value is that typically these groups, are really conservative. They're typically kind of managing for the occupancy, and to have just a steady cash flow that is no headache, right? So they're not maximizing for income. They're maximizing like to maintain occupancy, right? So there's usually opportunity for rents to increase to the market level. And then their expenses are usually, a little on the fatter side. So there's opportunity for us to come in and kind of lean things down. I think, especially being a local operator and really operate just in a more efficient way. And so we're seeing opportunity. We know we can make an impact day one, both on the expense side and on the rent and revenue side. And so I think that's where, with us, let's just say a more nimble player, a more local player, we see an opportunity to buy an institutional asset and really kind of take it to the next level. And so hopefully that was a kind of a good explanation.
That was great. Yeah, it was great. And it reminds me, like with the Doctors Investor Club, we've partnered with the Family Office Club. And so I go to these meetings with, billionaires, centimillionaires, decamillionaires, and they talk about this type of stuff, this institutional investing, if you will. And so you're talking about, downside protection risk.
Yeah.
There's cash flow, durability, being stable.
Yeah.
What, are these just for institutional type investors, or can this be for what we call the retail investor, or the local doctor or local, high income professional?
Well, I think it's simple in that, look, if it's good enough for the richest people in the world, then it's probably good enough for the rest of us too, right? Like there's a reason that they're doing it. I think part of what we're doing and part of, as we set out to build Hudson, was this idea of kind of democratizing these investments so that everybody can have access, right? And that's something that we're doing specifically on Maple Knoll. I told you who the last kind of 3 owners were, right? Now it's like we all have an opportunity to own that same product that these major groups originally had ownership in. And so, yes, it's for everybody. Yes, it's what the top 1% and even above that are doing. And so if it works for them, like, why wouldn't it work for us? Right. I think is a simple way to answer that. And one thing, just on what you've said and being in a group with those people and what they talk about, that's one of the biggest mindset shifts I've had as an investor, as I've grown and become a professional, is when you first start out in investing, it's all about what's the upside. It's all about, wow, get into real estate because you can make all this money. And what you learn is exactly what you said, is the smart guys in the room, the guys that have been there a long time, they don't talk about the upside. They talk about the downside and how do you protect the downside. And I think that's where, again, the size of asset becomes exciting, because it really is about risk adjusted return, right? So you're trying to get as much return you can for giving as little risk as possible, right? And so, when you think about that, that's what they think about. They think about, okay, what is break-even occupancy, right? What's the downside protection? Okay, well, what happens if things don't go or the right way? Are we still happy with our returns, right? And so, and is there cash flow and things like that are what the guys they've been doing it a long time really think about, right? It's like Warren Buffett's quote, like, first rule, don't lose money, right? And then from there you can think about, what the potential upsides could be. But I think that's a really smart thing for investors to know. It's like, it's first about that downside protection. And then inevitably you have a good business plan, you do it enough for the right things. And one thing that real estate's always proven is, like, over time, it will provide a good return, over time. And so, but anyway, I just think it's a great mindset shift for folks.
Yep. And another thing too is it's not as dependent, or you don't want to be as dependent on the market cycle, right? With these past few years, it's kind of shown, like, a lot of people had this bridge debt, and then all of a sudden rates shot up in 2022 and it screwed a lot of people.
Yep.
If you have an asset like this, more institutional quality, then you're not as dependent on the market cycle. Like if it, goes down, or if inflation continues to go up, you're protected in that regard. I mean, that goes along with your downside protection.
Yeah, absolutely. And I think looking at investments that have good cash flow is a way to not be beholden to market cycles, right? Because if you're getting a good, coupon payment, right, quarterly, you're getting a check, you're not as concerned about market cycles because you feel better about holding that property, and being able to sell it at the right time versus just waiting there, having to exit because you're not getting any cash flow off the property. You're not getting a return on your investment, right? So like, I mean, that's a great thing about real estate. If you're buying cash flow in properties, is like you're realizing your investment, your return throughout. And so it just allows you to hold and then sell at the right time.
Yep. Love that. And real quick on this deal, Maple Knoll, I mean, this is you guys have a handful in this area, but definitely, like, you just did a development last year, close on a development here in Westfield.
Yep.
Now you're about to purchase this property in Westfield. What is it about Westfield, Indiana, Carmel, Indiana, this area that you guys love so much?
I mean, it's all about the growth story.
Yep.
It's a fantastic story, right? Like I said earlier, right? Westfield has grown 34% in the last 5 years. And I live in Westfield. I know the story, Kyle. I mean, working in Westfield, living up here, and like the growth has been tremendous. And when you just see the businesses coming in, you see the retail developing, you see like the things to do. Like you got the Live golf tournament coming here and planting a flag, cool stuff like that. When you look at Maple Knoll is still what I would call maybe on the other side of the street from where all the growth has been. But there's literally a Wawa now on the corner. And so it's like, I think the growth curve of that part of town is just all upside, all upside and all about to really happen. And so that's really cool. But yeah, when you look at Carmel was just voted again. I think it was either number 1 or 3. I can't remember, but it's U.S. News and World Report, right? Best places to live. I think Carmel was 1. And then another northern suburb of Indy, Fishers, was like 3 or 5. But every year, Carmel is directly below Westfield, and Carmel is really where the affluency in Indianapolis has aggregated in a large way. And now it's landlocked and pushing up into Westfield and causing this tremendous growth north. I think the leadership in Westfield is very pro-growth, and we're seeing that come. And so anyway, because of all that, I mean, you just see the job creation and you talk about tailwinds in a market overall, but just massive headwinds in this small little microcosm of the world right now. And so that's why I said, as we really have focused on buying in Indiana, specifically buying kind of in the northern part of Indianapolis, and we have 9 properties in Indy. We have 7 properties kind of in the north side of Indy. And so we understand the market really well. Like you said, we're building a property actually right now, a couple miles down the road from Maple Knoll, which, they won't be competitors. They'll be kind of different levels with brand new construction, but we just have a lot of great insight into the market and just really believe the growth is going to continue to come here. And we're seeing it, every day.
I love it. Yeah, it's cool, man. I mean, it is cool to see. We obviously live in Westfield too. We're on the north part of Westfield.
Yeah.
And it seems like the growth from Carmel is coming. Like we see it coming, right? You're seeing, to your point, Wawa's and different things just being built as we get up here. We're ready for, a grocery store to be like down the street, and it will be in, a couple of years. And then we're going to be like, damn it, we were away from it all. Now we're like in the thick of it.
I know.
But I just saw recently too, in Sheridan, the town just north of us, a couple exits up, there's that big, water park? What is it called? Sky Lake or whatever?
Yeah. It's like a major natural kind of water park. They're building a couple of massive lakes.
It's insane.
So, I mean, I think more and more things to attract people to the area. Right. And so that's what you want. And we continue, I talked about my finance background. I mean, the other thing I studied in school was economics. And if you want to keep it really simple, I mean, one of the reasons I love multifamily is because we have a major housing shortage in this country, and we have for years. We have, for almost all of kind of recent history. And because of these big disruptions, like the great financial crisis and most recently COVID, we have years where there's just no building happening. Then you have interest rates going up, right? There's no building. And it's gotten even worse. And so the gap between the cost to own the average home to the cost to rent has never been wider, right? So if you look at it, again, just our property, Maple Knoll, the average home, or like median home in Westfield, is something like $420,000, right? And so if you look at the payment, the mortgage payment and the expenses to live in that house, let alone the initial down payment, it's about a $750 is about gap between what our rents will be after we renovate to what it would cost monthly to live in one of those homes. And so just the ability for people to buy a home, it's never been further away, right? And so people are renting longer, they're renting later into their lives. They're renting 6-7 years longer than they were 10 years ago. And so you're just seeing these trends that are driving demand for multifamily. That's why you're seeing so much multifamily being built, but we continue to absorb all of that because of the needs for housing is so severe.
Mm-hmm. Yeah, it's a good point you make. And so you guys are multifamily, and you're feeling obviously bullish towards multifamily, right? And the now and the future.
Absolutely. And it's a long-term thing. This cycle is not going to change. I mean, unless something meaningfully happens with government regulations for building, with interest rates, and with construction costs. I mean, all three of those are meaningfully have to change, I think, for us to ever really catch up on home building.
Mm-hmm. Yep, that's a good point. And I think that's a good point for any listener out there, because again, that shiny coin syndrome, shiny object syndrome, whatever you call it, is real, and a lot of people feel it. And so, self-storage was the big talk, and then it's residential assisted living, and there's always something, right? But multifamily is still something that's recession resistant, right? Like, I mean, during COVID, people still have to live, and they still have to pay their bills and live in a house. And so that's something that's always going to be there, especially with the stats you just brought up. So it seems like this is the almost, I shouldn't say sure thing, but it's definitely more certain than other asset classes that are still a little bit speculative.
Like I said, we're like the vanilla ice cream, right? I mean, it's, what you're going to get. It's low risk. It's not going to come out with something crazy on top of it. And that's exactly where we like to be, right? Long-term thematic investing, knowing that as long as the supply is below demand, what happens in Econ 101, right? Prices increase. That's what's driven rent growth. And as long as, the nice thing about the Midwest is you don't have everybody from all over the country coming in and trying to build like you did in Phoenix, you did in the Atlantas of the world and the Austins, and now you're seeing rent decreases. So we continue to grow steadily, continue to cash flow, and just the growth. I mean, because of things Indiana has done for business growth, being one of the best places to own a business. We just actually decreased our tax rate. They're decreasing property taxes in the state because of with the new bill that was passed, which is so. I keep getting this question on our underwriting. I was like, why are you assuming taxes are going down? It's like, well, because there was a law that was passed last year that decreases the assessed value of properties, 6% a year over the next, 5 years. And so it's really something unique to Indiana, where property values are actually going to go down. We expect over the next, by up to 33% in year 6. And so it's an exciting thing. I think it's a way to create value. And again, why we're so focused on investing here in our backyard.
Yep. I love it, man. You guys know it well. It's your strong point. And the other cool thing is, even with that development down the street in Westfield, you've partnered basically with the city. You got them on board.
Yep, that's right.
Right. For some TIF money. And so you have the connections. You have, it's in your backyard. So, I mean, you know it inside and out. So you guys are definitely at a great position. You've positioned yourself well to do well in this market. And that's why people outside of it really can't compete. Everybody wants to invest in Indianapolis, but they really can't because they don't know it all that well.
Yeah. And I think the Westfield story is so unique, right? That I think people that get it really get it. They really understand the growth and what's coming. And, it's probably hard to see if you're, living on the coast and you're just looking at, your reports and things that you're buying. You got to really be here on the ground and boots on the ground, I think, to understand. And, but because of that, we've had tremendous interest. I mean, in investing, I mean, the people that are local that get it, I mean, they want to be all in. And so some of the most fun raises we've had have been for these Westfield deals where it's just people understand the story and they're excited about it,
Mm-hmm. Yep, absolutely. Well, good. Usually we'll end with 4 quick questions, but tell us where, if somebody's listening to this and they're like, man, I want to invest in this deal, or I want to invest with them, I want to learn more about them. Where can people find you? Where can people find these investments?
Yeah, I mean, great info. So you can find, if you want to learn more about this deal we've been talking about, Maple Knoll, you go to HudsonInvesting.com. And then just click on our current offerings. You'll see Maple Knoll right there. So really easy to access. You can easily set up a call with myself, my team. Be happy to talk you through it or share any information. If you want to find me, so it's Ritter on Real Estate is my podcast. I also do a podcast like Kyle. You can find it anywhere you're listening to podcasts. And then it's my handle on Instagram as well, Ritter on Real Estate. So easy guy to find. And yeah, happy to answer anybody's questions if you want to DM me. And just happy to help people get the clarity to be able to make these types of investments. Even if it's not with me, to know that real estate belongs in everybody's portfolio because it is a fantastic foundation. And we should do it because, like you said, it's like what the smartest guys in the room, the richest guys in the room are doing. They all have real estate exposure. And so if it works for them, it'll work for you too. And that's kind of core to my message to people is, whether it's with me or not, everybody should have a piece to build a diversified portfolio.
Yep. I love that. All right. Last 4 questions real quick. What book are you reading right now?
Book I'm reading right now is actually this kind of interesting book called Building a Second Brain. I look because it's like right next to me, and it's I'll be honest, it's a little dry, but it's about this idea of we have so much information that we're ingesting every day in all these sources. And as we go throughout our day, we have so many ideas and things. And how do you capture all of that? And how do you make a quote unquote second brain so that you can refer back to it? And it's all about having kind of how do you take notes? How do you store it? How do you digitize it? How do you use AI to bring it all together, right? And so it's kind of cool. So it's all about, with everything that I take in, how do I make sure, I'm not losing ideas, but I'm also putting all these threads together, right? With all these great conversations I have with people like you and others. So yeah, it's Building a Second Brain by Tiago Forte.
It's fascinating, especially with AI coming, or I shouldn't say coming, it's here. But it's only going to expand these next 4 or 5 years.
Yeah, it's been incredible.
That's great. So what advice would you give to your 25-year-old self?
Buy a duplex, live in half of it, and rent the other half out.
House hack.
House hack. Yeah, I wish I would have known about that, way back when. I wish I would have started earlier. Without being so specific, it would be invest in real estate sooner.
Yep. That's good advice. Speaking of that, like I'm trying to, my kids go to school 3 days a week, and we're going to start Money Mondays here soon. And so where I can start to, just slowly talk to them about money. And then as
Love
they
that.
get a little bit older, they'll understand more. And so, yeah, to your point, we didn't know about that, right? At
Right.
25. Now there's so
Right.
much more information out there, but it's like, that's how you really learn about
Yeah.
real estate, is just by doing it. Do it the
Yeah, I
simplest
mean,
way you can.
absolutely. And if you can put yourself in a position at 25 years old where you're not paying a mortgage and somebody else is paying it for you while you're building equity, it's just a fantastic place to be.
Yep. No brainer. What's your definition of wealth?
Just being happy, having an abundant life, having a family that loves me and that I love and that I'm providing for. And God, that's really kind of it. I mean, it's not about money. I guess wealth to me is not about money. Money is about getting to a point where you don't have to worry about money, right? And so you can think bigger about other things. Because if you don't have food on the table, you obviously can't, think about a lot else. So it's about getting security. But then from there, yeah, wealth to me is just living an abundant life, having people that love you. That's what it's all about.
Good stuff. Proverbs 11:25 states, "A generous person will prosper. Whoever refreshes others will be refreshed." If you can make one lasting impact by giving back, what would it be?
Part of my strategic vision is creating a nonprofit, kind of coming out of our business that really is focusing on housing insecurity, helping people, make those mortgage payments, make those rent payments. I just view that, real estate's been so good for us. And I would like to give back in a way, but I'd like to keep it real estate related. And so that's something that's on the strategic plan, is to get that going. And we've started some conversations about it, but that's the way that I view building a legacy.
Good for you, man. Kent, this has been a great conversation. You're a phenomenal guy, very impressive with what you guys have done over these last 7+ years with Hudson. And so we're excited to see where all this goes and how you continue to build on it.
Thank you, Kyle. I appreciate you, man. It was a great conversation.
Absolutely. Yep. This will be good for everybody to hear. We'll probably get it out next week. So this will be exciting.
Wonderful.
Thanks, brother.
This is my time. I'm on the rise. Can't hold me down. I'm too fly. This is my time.
Thanks for listening to the Doctors Investor Club podcast. I hope today's conversation inspired you to think bigger, dream bolder, and take the next step toward financial freedom. If you're a doctor or dentist and you're ready to join our community, head over to doctorsinvestorclub.com. There you'll find our free mobile app and private forum, built exclusively for physicians and dentists, featuring AI tools, curated investor resources, and live event access. And if you're at the stage where you want to see real estate opportunities we personally invest in, you can visit investwithdrkyle.com. There's no pressure, just transparency, education, and access when you're ready. Subscribe to the show, share it with a colleague, and remember, you're not just building wealth, you're building a legacy.